coming from China
is cutting interest rates. It's cutting its one-year lending rate by 25 basis points.
Yeah.
Tom, you're a European economist, but the markets have been looking for more stimulus to come out of China. The market's going to react quite strongly to that.
Yes, and we have to remember the Chinese government has said on the fiscal side they weren't going to do very much. 2 years ago they had a massive fiscal package, huge amount of infrastructure investment. So we did need monetary policy to actually take the lead. We're expecting further rate cuts going forward. The economy is slowing, not only reserve requirements, but this is the first cut in interest rates. We'll have a bit more. They can march reserve requirements down to as low as 5%, which will get bank lending going, which is the main mechanism using state-directed banks. No, I mean, we have to remember the current 5-year plan that they've just announced wanted the economy to slow to 7%. They're very, very worried in China about essentially regional and urban income differentials. They want slower growth to try and keep essentially everybody rising at about the same level. So weaker growth, yes, they can throw stimulus at it, which is what they're doing at the moment.
And it's interesting actually to see that this lending, well, this cut, it will be effective on June the 8th. Are they also concerned about what's happening here in Europe? I mean, how much does that impact the domestic consumption?
The Eurozone is their largest export market. I mean, it's much larger than the United States because it's for bigger areas. So some of the slowdown that we certainly saw in China towards the back end of last year seems to be directly related to weaker exports and that whole sort of switch to domestic demand-driven growth, which requires consumption and therefore requires cheaper credit.
Feels to me like the Bank of England has just disappeared onto the back burner at the moment. The Chinese economy is one of the growth engines of the world at the moment. It's one of the few growth engines of the world at the moment. If the Chinese feel that they need to deliver stimulus, kind of makes you wonder what the rest of us should be doing.
I think it just adds to the perception that, with a weak West, what you want is a strong East, and if the East is weakening as well at the same time, that's undermining confidence. So this is an unsettling announcement.
Unsettling but positive, in as much as we need to be concerned that the Chinese economy is slowing down more than we thought, or positive because actually they're doing something about it?
Well, I think maybe it's slightly behind the curve. I think China is probably slowing more than we think, and so in that sense it is worrying.
Graeme, in terms of what we're seeing, does this actually tell the Bank of England that they should have done something today? We're hearing, talk about extra stimulus being put on the markets in the US. So China's doing this. Why did the Bank of England not act today?
Well, I think the Bank of England will act. I think the only question is when, and so I'm not too unsettled by them not acting today, but because I think they will get there. I think the money supply position means that they have to get there.
Okay.
Tom, talk to me about how volatile and how concerned are you about global growth in general? I mean, China's concerned about its growth. The Eurozone is extremely unpredictable. The Bank of England, for now, I guess, is just keeping its ammunition.
I think certainly in the West, where central banks have cut rates to zero, it is keep the powder dry in case you need it. We had a rate cut from Australia this week, so even the RBA were a bit worried about growth before we had the outsized Q1 GDP number. But we're really seeing the rebalancing. Yes, China is slowing, but then when it was growing at 9%, it had a huge balance of payment surplus, which no one wanted. We're seeing a bit of a slowdown in the emerging markets because of high inflation. Now, it was that food and commodity price inflation that most people blame for the weakness of the recovery in the West last year. Why did the UK slow down so much? Because oil prices and food prices were high, inflation ate into real incomes, and so we had weaker growth. If emerging markets are cutting rates, we have oil around $100 a barrel, commodity price inflation is coming off, that should boost Western real incomes this year and give us hope that next year we'll see stronger growth.
I just want to check out the commodity prices actually, because I'd be interested to see kind of whether or not the Chinese story is going to have a negative impact on European growth. If Brent starts rising, if copper prices start rising, that's going to feed back into the kind of inflation story that you're talking about. Is that something we need to worry about?
Well, I'm not too worried about the inflation picture here. I think actually the big issue here is that even without the Eurozone crisis, UK money supply growth was signalling we need more QE. With the Euro crisis thrown on top, it's a done deal. The question is how quickly, and I think it's going to be fairly quickly.
Is traditional QE, let's call it that, buying the gilt market the right way to proceed now? Tom was pointing out that you could say that it's had a mixed impact on the economy. The counterfactual is hard to argue, as you've pointed out, but nevertheless, is there a more creative way of delivering stimulus to the British economy than simply buying gilts? Everybody's buying gilts right now.
Well, it's certainly a blunt instrument. There's no certainty of the transmission mechanism. It can work different from QE2, from QE1 to QE3. But I just don't think the bank's going to budge there. I think the bank's stuck on a very traditional QE course. I can't see them wading into the corporate bond market at all.
Are we in a bubble? If we look at UK government debt, you know, the yields are so low, and yet we have growth issues also here in the UK. This is something that the IMF was pointing out just a couple of days ago. Is this going to go straight back up?
I think it will do eventually, but if there's still a belief that the central bank will step in and buy the market, then you'd be long of gilts. You know, we know why gilts are falling. It's a safe haven. The UK is the least ugly of the European economies, so we're getting some inflow. I think the risk here is again, it's why would QE do anything? If you're a central bank and you're buying bonds at 1.7, you might take it down to 1.5, locking in losses at that stage. Remember, the bank tends to be risk averse on its general portfolio. It's generally made money, hasn't lost much yet.
Tom, at that level, I can make most infrastructure projects economic. Why don't we do that?
Well, I think the government has been talking about this. We have heard about credit easing in the budget. Again, they seem to be delays.
Yep.
Now, we read these days about infrastructure savings bonds, which will be perhaps look a bit like national savings products to try and get savers a higher rate. I agree, given the bond yields, it would seem to make sense to ring fence off some money, put it towards infrastructure. It may not even really impact on the debt levels, depending on how creative you can structure it.
I think we could be surprised. I think there could be something fairly creative and fairly big that does come along. I think there's a huge political pressure on the government to do something.
In the next couple of months?
Another U-turn.
Yes. Yeah, yes. How many is it now? 3, 4?
4, I think now.
But I mean,
who's counting?
But this is
You are.
an unprecedented opportunity. You'd be very stupid not to take advantage of the situation now.
How big should that be? You could borrow a lot of money at these kind of levels, and most things are economic at 1.69%.
Well, I think we should be looking at a 50 billion plus infrastructure bond,
Which would be targeted at?
pension funds, etc. Using that.
Okay, but building what?
Key transport infrastructure, key energy infrastructure.
Right.
Now, it's not going to kickstart the economy. It's not shovel ready, but it can transform long-term prospects. So, in that sense, the government can sell it as a supply-side growth strategy, not a demand-side stimulus.
Are we going to see a bailout for Spain? I mean, that's a million-dollar question, Tom, which maybe you have the answers to.
We'll see a bailout. The question you have is how exactly are they going to put a mechanism together which keeps everybody happy? So the Spanish government does not want full troika conditionality. It would rather have sort of troika light. So yes, the banks get bailed out by European funds, but it doesn't have the onerous quarterly reports, this idea that money gets doled out.
Everyone would like a bit of troika light.
Well, indeed, they want free money. Now, the question you have within Europe is, should you give it to them given other banks' exposures to the Spanish banking system? Now, in reality, what we have in Europe now is really an idea that we just simply allow the banks to get too big as a percentage of GDP. These bailouts are very expensive, but that was, of course, because of the various interconnections. When the Bundesbank's on the hook for, 650 billion euros through Target 2, then you can argue that there is perhaps scope for a wider European bailout at saving the Spanish banking system.
What are the numbers going to look like, David? Because my understanding is that they're talking about 40 billion, but you kind of have to think that it would be sensible to go for something a bit bigger.
I think we're going to have to wait until, first of all, on Monday we'll get that report from the IMF. De Guindos was talking about that in Brussels yesterday. Then after that there's going to be 10 to 15 days for the independent auditors to come up with their views. The Spanish are talking about 40 billion. Other people are talking about maybe 80 to 100 billion. But I think we're going to have to, I suspect we're going to have to wait, particularly after the bond auction today, which ostensibly looked fairly good, actually. I mean, they managed to sell, a little bit more than they were looking for. Yes, it was a small amount, and they've had to pay...
They're not locked out, are they?
They're not locked out. No, they're not locked out, contrary to what the budget minister had to say on the radio the other day. Looks as if he wasn't quite right. So I think that we're going to have to wait a bit, though, before we actually find out what the end game is here.
Tom, how much would you read into this bond auction today? It was a small amount?
It was a small amount. They were short-dated bonds, and the Spanish banks would have bought all of them because they can use them as collateral with the ECB. Wouldn't want to read too much into it. If you look at the prices they were paying, even for short-dated bonds, they're about a percentage point higher than the last auction. So yes, they can get this away, but at a price. Of course, you can see this as a backdoor recapitalisation of the Spanish banking system. If they can do this for another 200 years, they might recapitalise it without recourse to the rest of Europe.
All right, Tom, thank you so much for all of that.
Cynicism. Excellent.
Tom Vosa is Head of Market Economics for Europe at National Australia Bank in Europe. Editor David Tweed, thank you both